Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar. Bert Salazar. Bert Salazar.
Hey, good day, everyone. Welcome to the Bert Salazar Retirement Show. My name is Bert Salazar, and I am going to be the host, as I am every single week, for all of you. And this is going to be a very good episode because this is going to be a follow-up to the episode that I did last week, which was called Is Pension Maximization Right for You? And, we kind of went through the whole spectrum of, products. I didn't go into many details, which I will in this podcast, but I did go through, some of the major flaws that products have and so forth, and where do they fit in your financial arrangement, especially as you're preparing for your retirement, whether it's going to be 6 months from now, 5 years from now, or perhaps some of you may already be in retirement. So this is episode 173, and the title for this episode is All Financial Products Are Flawed. So I want to start going through a lot of the challenges that all of you are going to be facing, especially as you reach retirement. And the better job that you do in identifying some of those challenges and the opportunities, and you prepare for the challenges and opportunities ahead, and you do so with plenty of time, the better off you're going to be from a financial standpoint. So I think one of the major questions that you should be asking yourselves, and in many ways I asked myself many years ago, is, why are financial products flawed? And there are many reasons. Some are just the environment. Other reasons may be the government and the corporations and financial institutions. So I'll kind of walk you through those. And then I'll go into specific products and their flaws so you can take a look at, how it is that they work. And then finally, I'll give you one example of, how you can get rid of the flaws while maximizing the opportunities and the benefits of those products. So why are products flawed? Well, there are many reasons. For instance, products have different goals and different objectives. So if you're 40 years of age or you're 80 years of age, your goals and objectives are going to be totally different. So financial institutions design products based on potential client goals and objectives. There's also microeconomic approach to financial institutions and financial solutions. So you would figure that financial institutions on an ongoing basis are trying to figure out how to design financial products. And they do so on a microeconomic approach, which means they're looking at a problem, at a specific problem, and that they're trying to design a solution to that specific product. Now, at the end of the day, there's something in it for financial institutions and insurance companies and mutual fund companies and so forth. The more products, the more revenues for financial institutions, and that is the fact of life. So the more product that a financial institution brings out in the marketplace and sells to the American public, then obviously the more revenues are going to be generating. And not only that, the more diversification of revenues, because they're not going to have all of their eggs in one simple basket. Now, another reason why products are flawed in the United States and many times throughout the world is governmental control and tax laws. So many times the government gets in the way, and not necessarily for good reasons, but then you figure that financial institutions are going to take a look at new laws or new guidelines or new regulations that the government poses and puts out in the form of a law. And then they have to do a workaround. They have to find products that are going to be suitable to kind of mitigate those laws and those regulations. And that's why you have so many of them in the United States. The other thing is that financial institutions and governments have a microscopic view of the world. They just want to solve one problem at a time. And yes, having individual products is a good thing, but also can be detrimental to an overall financial view. So since financial institutions and the governments have a microscopic view of the world, I think American citizens and Americans that are investing in these products on an ongoing basis should have a macroeconomic view of their financial goals and objectives. In other words, instead of looking at the micro, instead of looking at their financial world through a microscope, they should be looking at their financial world through a telescope, because the view is going to be totally different. Plus, it's going to give you, the investor and the retiree, a much better view of how to solve different problems that you may have in your portfolio, because of the fact that for so many years, both yourself and the financial institutions were making decisions on your products through a micro perspective as opposed to a macro perspective. And that's where strategic design reduces product flaws. Now, at the end of the day, we all have to use the products that are available, but the more understanding you have of the different flaws of these products, then the better position you're going to find yourself in when it comes to providing solutions, not only for yourself, but also for your family and for your retirement as well. So now that I have given you some kind of an overview as to why products are flawed in the United States and throughout the world, let's talk about specific products. And there are many of them, but I'm just going to give you a view of the major products that most of the clients that I deal with on an ongoing basis find themselves involved in. By the same token, the one question is, well, is there such a thing as a perfect financial instrument? Now, it doesn't exist today, but there is a perfect financial instrument. And as far as I'm concerned, that would be a financial instrument that would allow for pre-tax contributions, tax-deferred growth, tax-free distributions, no surrender periods whatsoever, and no tax penalties under the IRS code. There's no such a product, but that would be the ideal perfection of a product. So whenever I do any type of financial audit on a client, and then I start to put a strategic design, I want to get as close as I possibly can to a perfect financial instrument. Now, I'm never going to get to perfection because there's no perfect product in the marketplace, but I'm going to try through strategic design to get as close as I possibly can to some kind of perfection from a business and financial standpoint. Now, the other challenge that brings about the flaws in products are government and tax law controls. So if you take a look at the taxation of all products that we all purchase in the United States, I'm just going to concentrate on the U.S. today. You have your taxable products, you have your tax-deferred products, and then you have your tax-free products. Now, your taxable products are your traditional savings accounts, CDs, traditional mutual funds, and so forth, where the money going in is, or the money going in is after tax. The growth is taxable every year, and then when you pull the money out, depending on the type of product that you may have to pay a long-term capital gain taxation as well. So that creates a problem because, yeah, it gives you liquidity, but from a taxable standpoint, you're being taxed at the very beginning, during, and then at the end. So it's not a very efficient tax beneficial product or combination of products or financial boxes, as I call them. Then you have the tax deferred growth, and these are the products that allows you to put money in on a pre-tax basis. The money grows tax deferred, but then when you pull it out, you have to pay taxes on the whole thing. On top of that, because of the fact that the IRS gives you the ability to defer the taxation on those products, then they're also going to put certain limitations like the 59.5 rule and the 72 rule. If you take money out prior to age 59.5, you're going to have to pay not only the taxes, but also a premature distribution penalty. And then if you happen to be in this box and you've invested in products like, IRAs, 401ks, pensions, and so forth, then you're going to have the 72 rule, which means that at age 72, whether you need the money or not, you're going to have to start taking distributions, because otherwise you're going to be penalized. And the penalties are very, very hefty, because the excise penalty on age 72 is actually 50%. So if you don't take the money out of these qualified plans by age 72, not only are you going to have to pay taxes on that minimum distribution that the government is going to require you to take, but also they're going to charge you a 50% penalty on top of that. And then the last box, financial box, other than the taxable and the pre-tax that I just walked you through, would be the tax-free box. And the tax-free box is the one that includes your Roth IRAs, your Roth 401ks, and also your life insurance contracts. Now, as far as the Roth IRA and the Roth 401ks, you don't have the age 72 rule, but you do have the age 59.5 rule. So that creates certain challenges, because if you happen to be 30 years old, you're not going to be able to take the money out until you're at least 59.5, unless you want to pay taxes on the growth and so forth. So the government also is guilty of creating a lot of these booby traps that are giving you some of the challenges from a taxable standpoint that I just walked you through. Now, if you take a look at savings and or let's say CDs, certificates of deposits, there are surrender periods. You can buy a 1-year CD, a 3-year, 5-year CD, and anything in between. And obviously, if you have to cash out that CD prior to the end of that period, then you're going to have to pay a penalty for that. Then in addition to that, there's also annual taxation. So that means that if you want tax deferred growth, you're not going to have it in a CD. You're going to have to pay taxes on the distribution every single year. And CDs are very, very susceptible to interest rate environment. I remember, back in the 90s, I had clients that were retiring, and they were able to put, $500,000 or $1 million in a CD and have the money and have the CD pay out 5 to 6% interest per year. So my clients were generating anywhere between, $50,000 and $60,000 of interest every year. Try doing this with a CD. Or try doing that with a CD today, you're barely going to get 1% or $10,000. So they're very inclined to interest rate volatility, and that creates a major problem for CDs. So how about traditional mutual funds? Well, you'll have to deal with the internal fees of those mutual funds. You're going to have to deal with the annual taxation of the dividends. So if you're investing in a mutual fund that is paying a dividend on an annual basis, you're going to have to pay taxes on those dividends, so they're going to be taxed based on your ordinary income tax rates. In addition to that, you may have to pay taxes on short-term capital gains, which are then going to be taxed again at your ordinary rates every single year. And then when you do sell the mutual fund portfolio or a portion thereof, you may be liable for long-term capital gains as well. And most important, because you're in a mutual fund portfolio, there's going to be stock market liabilities and volatilities that you're going to have to deal with. So once again, and there are good things about investing in CDs and mutual funds and savings accounts and so forth. But today's episode is kind of giving you the different booby traps on each and every one of these products so you can be aware of what to do in order to alleviate or eliminate some of those liabilities. Now, if we take a look at, let's say, individual securities like stocks, then obviously you're going to have an increased liability as opposed to a mutual fund, because now instead of a mutual fund where if you invest $10,000, you're going to be investing in a pool of companies, so you're going to be diversified. Yeah, there's still going to be liability, but you're going to be a lot more diversified because you don't have all of your eggs in one basket. When you do invest in an individual stock, then you will have all of your eggs in one basket unless you have sufficient assets to be able to buy multiple stocks at a given time. And then you're like creating your own personal mutual fund portfolio, but it's based on individual securities. So it's going to give you that increased liability. It's also going to give you the annual taxation of dividends that the individual stocks are going to generate for you. There are going to be internal fees, and there's going to be also short and long-term capital gains depending on when you sell the assets in that portfolio. Bonds, obviously, they also have their issues. And by the way, there is a need for bond in portfolios as well. I don't use them as much because there are more liabilities in bonds than you may imagine. But, you have surrender periods. You have low interest rate environments, and this is something that we're going through in the US today. But as interest rates start to creep up, a bond portfolio actually reduces its value because there is an inverse relationship between purchasing a bond and interest rates volatility or interest rate volatility. There's also something called the inverted yield curve, which basically means that short-term bonds may have a higher rate of return than long-term bonds, which is not usually the case because of interest rate volatility, and that may impact a current bond portfolio that you may have. And then obviously there's going to be taxation at some point in the future when you liquidate the bond. And by the same token, the interest rate impact is going to be many a times quite high when it comes to that individual bond or bond portfolio. Now we fall into insurance products, and you have annuities, and there are many different types of annuities. Now, I use annuities quite a bit with my clients because of all the benefits that they have. But by the same token, they also have challenges and they have flaws. So for instance, annuities have surrender periods. Now, depending on which type of annuity, if it's a qualified annuity like in an IRA or a 401k, then you're going to be susceptible to the 59.5 rule and the 72 age rule as well. Annuitization, which is one of the best features in an annuity contract, that you can actually annuitize a contract and have income for the rest of your life, so you don't have to worry about running out of money before you run out of life. It also has that annuitization also has a flaw, because if you take the optimum annuitization, when the person dies, the money is gone and there's no additional money for somebody else unless you take a survivor benefit, but then now you're depleting that annuity payout on an annual basis. So I need to not only include annuitization as a benefit, but also I need to include it as a flawed. But then I'll try to give you an idea of how to fix it, which is how I do it with many of my clients from a retirement standpoint. But it's apropos for me to, kind of share with you that annuities also have flaws. And there are different types of annuities that have different types of flaws. You can have fixed annuities, you can have variable annuities, you can have fixed index annuities, and they all have different flaws that you need to deal with, and they also have different benefits. Term life insurance, if you buy term insurance, and most of my clients also own term insurance, or at least a portion of their financial world is made up of term life insurance. And they have obviously the liability of term periods. So you can buy 5, 10, 15, 20, 30-year term period life insurance. And then you also have what is known as another flawed, which is loss opportunity cost. That means that, if you buy a term insurance for a period of 20 years, and then you're still alive in year 21, guess what? Now that term product went away, so the premium that you paid toward that product and the interest that you could have earned on that product in another investment are now a loss opportunity cost. So because you're still alive, and you also lost a death benefit because you're still alive. So the only way out is now to purchase perhaps another term insurance contract for another 20 years. But guess what? Now you're 20 years older, your health may not be as adequate as it was 20 years ago, so you're going to have to deal with those things. But in the meantime, if you have a death, and I have had a number of my clients that have died during that term period, then at least you have a product that the premium was fairly low in comparison to the next product that I'm going to talk to you about, which is your permanent life insurance products. And permanent life insurance, it means that it's going to be with you for the rest of your life. Now, because of that, the internal costs are going to be higher, because now insurance companies have to use the laws of probability and factor death over a very, very long period of time. It could be 30, 40, 50, 60 years down the line. So they have to increase their cost in order to offset the fact that they're going to have to pay a liability over the next 50 to 60 years. Permanent products do have cash values, which are very, very good. And in another podcast, I'll give you the benefits of cash values inside of life insurance, but they also have their detriment. Most of the premium that you paid in the first 3 years toward a permanent life insurance policy is going to go toward the cost of insurance. And then in year 4, now your cash values are going to build, and then eventually they're going to surpass it. They're going to do very well because of the tax benefit features that they have. But it's going to take a little bit of time for the money to ramp up inside of the cash value. So I also like to think of that as a detriment or as a flaw. And then obviously you're going to have break-even points. How long is it going to take where the growth inside of my cash value exceeds the premium that I have put into the investment that I have made into the contract. So now, as you're looking at your financial goals and objectives, and you look at your financial products, and if you do so through a telescope as opposed to a microscope, now you're starting to see the different flaws that all of the products that you have in your portfolio have that you had not been able to see before. And that's where you're now starting to look at a strategic approach of how to resolve, or perhaps even, how to minimize the majority of those liabilities by bringing products together, by creating combinations of products or straddles of products, as I call them, in order to maximize your retirement benefits while reducing your flaws and liabilities. So I'm going to give you one example, and then I'll close the podcast for today. And this is one example that I use with my clients often. And most of the clients that I deal with are preparing for retirement now. And as I said many times, one of the many challenges that we're having in the United States is that most Americans are going to run out of money before they run out of life. And they're also going to have to deal with, long-term care issues, inflation, taxation, and so forth. But let's concentrate on the fact that most Americans are going to run out of money before they run out of life. So most products are not created to avoid running out of the money inside the product before the client runs out of life, except for retirement annuities, because they were designed for that purpose. Now, you don't have to annuitize a contract, which is what I'm about to share with you that I do with many of my clients. You can buy an annuity for the sake of purchasing tax-deferred growth. The guaranteed, if it's a fixed index annuity or a fixed annuity, you want guaranteed of principal and so forth. But the beauty of annuities is that, let's say you have $1 million of annuities, or you have $1 million portfolio of mutual funds, and you walk into an insurance company and you say to an insurance company, look, I want to give you $1 million, and I want to make certain that this $1 million is going to last me until the day I die. When you do so, basically what you're doing is you're turning $1 million over to the insurance company in exchange for guaranteed for the rest of your life. It doesn't matter whether you die at age 85 or die at age 105. That annuity is going to continue to pay you an income for the rest of your life. And next week I'll do a podcast on annuities so I can go into a little bit more details as to the different payouts and so forth. But for now, just stay with me. So you go to the insurance company, you give them the $1 million. They're going to give you a guaranteed payout depending on your age. It could be anywhere between 7 and 13% payout. So in $1 million, they may give you between $70,000 a year to $130,000 a year, depending on your age. And that's going to go for the rest of your life. Now, what if you happen to be married? Or what if you want a portion of that income to go to a survivor family member? Then this type of annuitization, which would be a life-only annuitization, would not allow for that. It's just going to pay you until the day you die, and the day you die, that's it. The money goes away and no one makes any more money. Now, if you bought it at age 70 and you died at age 71, you lost big time. But if you purchased a contract at age 70 and you lived until age 100, you made out like a bandit. And then obviously there's that realm in between that you all have to deal with. But what if you're married and you want to enjoy the best of both worlds? Because if you're married, you're not going to, unless you're going to do some strategic straddle, you're not going to be able to just purchase that annuity on a life income only, because then the day you die, you're going to disinherit your surviving spouse, and you don't want to do that, especially if you love that person. So you're going to do a survivor benefit, so you may do a 2/3 survivor benefit, you may do a 50% survivor benefit, but what that means is that while you're alive, that benefit payout now is going to be reduced from $70,000 or $130,000 to maybe $50,000 and $85,000 or something along those lines. And so now you got to live with less money. But what if you do a straddle or a combination? What if you take that $1 million to the insurance company and you say, or let's make it even better. Let's say that you take $900,000 to that insurance company and you say, look, I'm going to give you $900,000, give me a guaranteed payout income or life income only for the rest of my life. And then you take the other $100,000 and you buy a life insurance policy for $900,000 as well. So what's going to happen is you have just created a straddle. Because while you're alive, the $900,000 is giving you tremendous income, probably the same income that you would have received on that $1 million annuity, or even more, if you had to use a survivor benefit to protect your surviving spouse. This way, both you and your spouse can enjoy the maximum payout that annuity can give you. Because once you die at some point in time in the future, whether you died at age 71, or at age 80, or at age 85, or at age 90, or at age 105, when that annuity payout goes away, because it will die the day you do, then now the insurance company is going to come in with that $900,000 of death benefit from the life insurance contract and replace that annuity. So now your surviving spouse is going to receive $900,000 of tax-free income or tax-free death benefit payout, which now your surviving spouse, whether it's a he or a she, can now go to an insurance company and buy an annuity for himself or herself, depending on how much they need, or they can take that $900,000 and say, okay, I'm going to buy, an annuity, guaranteed annuity payout for $600,000, and I'm going to keep the other $300,000 in cash so I can do other things with it. But the only way that you were able to do that was because of the fact that you looked at your finances through a telescope as opposed to a microscope, and you just created a perfect strategic designed or a product straddle combination that gives you the ability to reduce the inherent flaws in your annuity, but you are taking it off the table with the purchase of a guaranteed life insurance contract. And I have many examples that I can use with you. And in this situation, the life insurance contract actually became asset insurance because it protected those $900,000 that were going to go away at some point in time. And by the way, very seldom does a $900,000 go away, because when you annuitize a contract, this is what happens. The insurance companies is giving you not only interest, but also a portion of the principal of the $900,000 that you deposited with the insurance company. So if you live 20 years before you die, you also received a lot of that principal back. So perhaps by the time 20 years go by, out of the $900,000, you already received, $400,000 in principal, plus the interest on top of that. So at the time of death, there would have been only $400,000 left on the annuity side of the house, although they were going to have to pay you for life. But now a new $900,000 of death benefit is replacing that original $900,000 of an annuity purchase that you did 20 years earlier. So I'm hoping that over the last couple of our podcasts, I have given you information as to kind of take a look at your financial portfolio. And all of you should be able to do this. And what I do recommend is to kind of put everything on the table, look at the different flaws in your portfolio, or better yet, might as well reach out to me, because this is what I do for a living as a retirement strategist. And always remember, if you have any questions, feel free to call me. You can reach out to me at area code 786-766-1042. You can also send me an email at Bert, B-E-R-T, at bertsalazar.com, BERTSALAZAR.com. And always remember that my goal for you and for your family is to kind of help you change the way that you see things, because when you change the way that you see things, the things that you see change. So once again, thank you for giving me a few minutes of your time, and I'll talk to you again soon. Take care. Bye-bye.